What's up? Happy 2023. 2023 is starting out way better than 2022. I'll tell you that much. All my shit stocks are going up. Catalysts are working. Stock market appears stable for now. I don't even need the stock market to go up. I just need stable. Less volatility, please. Thank you. Anyway, how's everyone doing? Thanks for joining. Let's talk stocks. So, DCP worked beautifully. If only in 2022 I just stuck with majority minority buyouts and didn't speculate on LBOs, I would have saved myself a whole lot of money. God, even when there were strategic deals that I thought would happen, didn't happen. I lost money in every form of speculative buyout in 2022, whether it's CGen or Zendesk or Magnachip, of course, was my biggest loser by far last year. I mean, the list goes on. NCR. I don't even know what else I'm leaving out. Those are just huge losers. But then I made money in a lot of majority minority buyouts. I made a lot of money in MYOV. I made a lot of money in SHLX. I made a lot of money in DCP, though that was this year. I can't even remember what other buyouts there were that were successful last year. But anyway, DCP was fantastic. I'm no longer involved. Obviously, now it's basically like same thing as having money in a checking account. And I moved on from that. OCUL, I mean, come on, 370. I pitched down here at 280 a few weeks ago. I think the most that went down from there was like a dime. And Dextenza sales came in at the low end of what I thought they would, and it still surged. The key to this story, was very simple. It's still very simple. You had three prongs. Dextenza was going to put up a good quarter, the first quarter of growth in 6 quarters. They did. The second prong is that they said they're not going to raise any money down here, and that they are actively looking to raise non-dilutive financing, either through selling or partnering with Dextenza or by partnering any of their lead drug candidates. That is still ongoing, that catalyst. And if you look at the presentation that they put out on Monday, you'll see that they specifically mention partnering the lead candidate. And I feel very good that in the next 3 months, it could be longer, I guess, but I would definitely think by the summer, we will get a deal that will bring in a lot of money for OCUL, and I think the stock will double or more as a result of whatever deal they do. So I haven't sold any shares, and I'm very, very bullish on OCUL. We'll have new data for their lead candidate the first week of February. I think that's highly de-risked already, given the fact we've already had the 6 and 7 month data. This is month 9 and 10. We already know it works, and we already know there's durability. The question now is just how much durability. I'm feeling good about that readout in February. So those are basically your two catalysts. Your first week of February readout, and then at any day you could get a partnership for that drug or a Dextenza sale or partnership. Very bullish on OCUL. ARDX, I mean, it's been a home run. It's 290. I pitched it on here at 60, 70, 80 cents. And I still own all my Jan 24 call spreads. I think that it's been hugely de-risked based on the language from the company and the FDA. It will be approved this year, excuse me. I don't know exactly when, but very, very, very likely to be approved. If you couple that with their current commercial business, which is actually the same drug for different indication, the company is extremely valuable because there really will be no competition for indefinitely. The reason why this drug was approved via the appeal process is that there is no pipeline for treating these patients outside of the binders, and it could be $1 billion drug. So it's very attractive as an acquisition candidate, and I firmly believe that ARDX will be well above $5 this time next year. It could be as much as $10. Again, with very low risk. So all those spreads remain on. I should make 3 to 4 times X where they were at now, versus I think when I originally put them on, they were 10 baggers. So I'm very happy with the way that has transpired. And let's talk ideas. So let's start out with magnet chips, shall we? What a year magnet chips had already at 1075. I never thought I would be excited about 1075 at magnet chip. And that really should give you some context about how cheap it is here. So the first thing that's very important is the Korean won has surged in the last 3 months. Korean won is now at levels that it was at in the spring. And as a result, if you were to use the 1.2 trillion won that LX was rumored to have offered for magnet chip that they rejected, that is now worth as much as $22 a share, versus at the lows of the fall, it was like 17 or 18. So a huge difference in the currency that LX needs to use to buy magnet chip. Number two, there's been multiple articles starting in December, and then the last week in January, that LX is now interested in buying magnet chip again, probably as a result of the currency movement. The most amazing thing about magnet chip is that at 1075, it's now a little bit above tangible book value. And, when you're looking at something like this, the way I view it is what my risk is. Now, mind you, when the stock was 23 and 20, I thought my risk was the 15, and I just couldn't have been more wrong. And it cost me, a whole year last year. But at 1075, when you look at cash, inventories, even just the value of their PP&E, again, tangible book value, you take out all their liabilities, you get to this stock price. So it's basically value magnet chip as a company that will never, make money again, in a sense. And there's lots of reasons to be optimistic that 2023, at least in the second half, will be much better than 2022. You can't really get worse than what magnet chip has done. In my wildest dreams, I didn't think that they would have their business implode the way it has imploded. So if you think about it from a downside upside perspective, I think LX would gladly pay $20 a share today, which is below the 1.2 trillion won. Mind you, magnet chip's also buying back stock right now, and I'm using that $22 price with no repurchases in it. So every share they bought back at $9, $10, $11 is accretive, immensely accretive to a $22 takeout. You probably get to more like a $23 or $24 stock price with 1.2 trillion won based on how much stock they've taken out. There's immense value at $10.75. Will they get to the finish line and be able to take it out? I don't know. The most interesting thing, I think, is that you've seen no token purchases by board of directors members or the CEO in the last 3 months. Mind you, the CEO bought 10,000 shares at 18 or 18.50 back in January or February of last year. And that was 180 grand, but I still consider that a token purchase. And given the immense disaster this company has been, I would have definitely expected to see some member of the board buy 5,000 or 10,000 shares at $9, $10, $11, $12 just to show their sign of support so an activist doesn't come in. And no one has done it. And that leads me to believe is that they are actively still engaged with LX. And, the hard part's going to be coming up with a price. I mean, I wouldn't be very happy if they sold the company at $16 or $17 or $18 today. LX has been demolished too. So they might not get there because they won't be able to bridge the price gap. But a year from now, 2 years from now, if they don't sell now, you could easily get to a $25 stock price because, again, they've taken out a lot of stock. So the number of shares outstanding is much less. You should have another cycle where, both their businesses start surging again. And the exit here is a sale. I mean, this company was already sold once. So the shareholder base wants a sale, and a sale will happen. So yeah, for as shitty of a company magnet chip is, I'm very enthused by what 2023 has in store for it. It's like my second biggest position behind LGF. LGF smaller than it once was. That's still like 50% of my portfolio right now. and I use leverage, so that's 50% of equity. You know, LGF, nothing new has happened. It's obviously I've been immensely disappointed with how that went last year. Put that one up again in the pre-deal speculation, even though all I was looking for was a 20% sale of one of the businesses, and they weren't able to do it. I was eyes wide open, knowing that I wasn't going to do pre-merger ARB then, and I still lost. Basically, listening to management, and that one's that one's very painful. But I think 2023 should be very different there. You have the first time in years they have a really good slate coming out, and that usually does well for these stupid companies. And you've had massive insider buying from two of the most savvy media investors of all time, basically on the board. And MHR bought for the first time since 2020, and MHR is not putting more money in to have it go to zero. There's also been some terrible sell side downgrades that are just faulty math. And all this stuff sets up, again, for just a great year, because people don't get this in this business, but you want to buy stocks when shit is the worst, right? Magnachip printing like no revenues is the worst. When you can buy something at tangible book value when it's printing no revenues, how exactly will things get worse from there? With LGF, it's the same thing. You know, they missed the strategic process. All the streaming businesses look like they're in big trouble. It's levered, but it's really hard for things to get worse here. And you have multiple events in 2023 that should work in its favor, and it shouldn't exist. I know I say that about almost all my companies, but it just shouldn't exist. So I'm pretty optimistic that you will see a sale on LGF in one or both of the divisions this year. I don't know if the spin will happen, but if they don't do the sale in one or both of the divisions, then I think you'll see the spin for sure. Stars shouldn't exist. We all know that. I mean, it's like not even a second tier. It's like a third tier streaming service, and it just shouldn't be around. They shouldn't. They know that. They know this. So my third biggest position, or it might be my second, it might be tied with MX, is NCR, and most of that is in call spreads. When I say biggest position, I'm doing it delta adjusted. I have a lot of call spreads in all these names, all three names. Magnachip is mostly just common these days. I have a lot of Jan 15 calls, Jan 24, 15 calls, but they're not really worth that much anymore. LGF, I have a ton of DEX 750, 1250 spreads, June spreads. I have some March spreads. A lot of my December spreads, most of them all expire worthless. But with NCR, it's a lot of spreads. I have small June, pretty big October, and then huge Jan 24. And they range from 28.33 to 30.35. NCR, to me, just has everything going right for it right now. If you look at their Q3 and their Q2 earnings releases, you will see they had a 4% headwind from currency on revenue for both of those years. And I'll answer that question in a second. Happy flying. And it was an 8% or 7%, 700 basis points EBITDA hit in Q3. They don't quantify it in Q2, but it's probably exactly the same because it was the same revenue hit. 700 basis point EBITDA hit is huge. I think it went from like a 15% EBITDA growth to a 7% EBITDA growth or 8% EBITDA growth. If you now look at what the euro's done, and it's reversed completely. It's just surged the last 3 months. So NCR now is going into 2023 with a huge currency tailwind, and that will make the numbers explode. There's just tons of operating leverage in the business. So if you couple that with the fact that there's a decent chance that financing opens up for LBOs in 2023, especially as we're now ending the Fed tightening cycle, I think there's a strong case to be made. I said many times that NCR gets taken out for as much as probably $45, but the range is probably 37 or 36 to 45 versus the 24.50 it's trading at today. And happy flying 2008. Why spreads? Why not common? I own common too, so it's both. The reason why I chose to goose it so much with the spreads is that it's a levered business. And that's kind of how I do all my investing. You know, you want to own only common when you are so confident that there's no downside. And with, as I've learned the last year in the hard way, even when you think there's literally no downside, there's so much downside. Just, it's how it always is in bad markets. And it takes a bad market for me to be reminded of it, even though I've been doing this 20 years. So, you know, with MX, I think I was joking with Twitter today about this. There was a guy that used to be on my YouTubes that back in January or February last year was telling me that MX was going to 15. And I think I basically told him, like, you know, if MX goes to 15, I'll, you know, I'll pull a, McAfee and what he would do if Bitcoin went to 1 million. And I didn't say that, but that's basically what I was telling him. And not only did MX go to 15, but MX went to 875. And if you look at it from an enterprise value, MX's enterprise value went down even more, like 90%, you know, since there's so much cash and stuff. So with NCR, it's the same thing. If it went into a bad recession, you know, NCR could go to $10 or $12 or something, because, you know, you have so much debt in the business, even though it's not, I don't think it's that overly levered or anything, but it's still like a public LBO in a way. So I love the setup of spreads and things like this, right? The way I approach my investing is, and I did it with AYX too. I'm gonna talk about AYX in a little bit, but I take a stock, and it's very rare where I invest in a company that could be up like 400 or 500%. You know, most of my stocks are kind of value-ish businesses that I think have 50 to 100% upside. And I think there's going to be an event that crystallizes that upside. It's pretty much always how I invest. Not always, but most of the time. So with NCR and with AYX, I'm going to talk about AYX in a minute. Specifically with NCR, even more than AYX, I don't see a scenario where this would be a $50 or $60 stock anytime soon. So I'm not worried about, you know, giving up the upside. But what I am concentrating on is what's the threshold, what's the level I think it will almost certainly get to. What's the likelihood it will get there, and when will it get there? And with NCR, you don't even need a sale. If the business does execute the way I expect it, or hope for it to execute in 2023, and they do spin off the business at the end of 2023, which will then help facilitate sales in both the businesses, you should be well north of $35 once you get into Jan 24, because the businesses are worth well more. You have to understand, a private equity firm is going to pay probably $43 or $44 a share, and going to make 25% IRRs after that by splitting up the business. And that was going to be last summer. So if you fast forward 18 months, you accrue all that value that you have. FX is reversed, you know, so that's created new value. And then, you know, who knows what happens, you know, with the underlying businesses, if they accelerate or whatnot. So when I put on the NCR spreads, I paid $1 or less for every one of those spreads I named. The June 28.33, the OCC 28.33, the OCC 30.35, and the Jan 24 30.35. So I'm putting up $1 to make $4. And if I bought the stock here at 20, the stock was like 21, 22, 20 when I was doing it. So the stock would have doubled from 20 to 40, and I would have doubled my money. Or I put up 85 cents and I make $4.15. And that's why I do it. It's a huge way for me to goose my returns. The downside of putting on so many spreads is that when the market goes down 15, 10, 20%, all the spreads get obliterated. And I have so much money in spreads across all my names that when that happens, I take huge P&L hits. And it's really painful. The good news is that once they get obliterated, you know, my position's all right size, because there's no money left anymore in the spreads. And unless I refresh them, I just have the common left. So that's how I structure them with all my names when I put on event names. It's common, and then I put on call spreads. The other thing I like about spreads is most of my stocks, it's very hard to put on options. You know, if you bid for options, the spreads are very big, the bid-ask spread, and you really just can't do it. I'm not buying Apple or Microsoft or something. When you put on spreads through interactive brokers, you basically can middle the bid ask on the spread, a little bit worse than middling. So it allows me to put on the position, and I can't do that by just putting on the calls. So that's, anyway, that's a little bit of background of why I like putting on call spreads. AYX is, I've talked about in the past, it's a software name. And the reason why I got on my radar originally was in February of 2022, they put up a very large management incentive plan for change of control and also to hit thresholds above $90 a share. And over the course of last year, they executed perfectly, and the stock is lower. And there's been absolutely no insider trading on AYX in probably the last 6 months, 3 to 6 months. A board member of AYX bought $50 million worth of stock at higher levels in March or February of last year. His funded. AYX is controlled by 2 people, and there's no reason to put in change of controls for management teams if those 2 people don't think they're ever going to sell the company. And to me, that means they're planning for a sale of the company. Whether it happens in a year or 2 or 5 remains to be seen. I believe after the COUPA, C-O-U-P takeout last month, you have a very good comp of what an AYX sale would look like. And I believe you get north of $80 a share in a similar transaction. I think there's a lot of things about AYX that are superior than COUPA. And namely, I think that it's growing much faster. And I think that the revenue recognition of the company is all messed up, and the analysts don't know how to model it. And all the numbers for next year are too low for this year, 2023. And I think it's just a perfect market cap and appetite for a private equity firm. And these deals are getting done in this environment. Now, I don't know if it's going to happen tomorrow, next month, or next year, but the valuation you're paying for it is very low. And I think part of the reason why, Maisie, why it's trading where it is it doesn't screen well. There was very negative free cash flow last year. And also they have debt due in a little debt's due this year and then more debt's due next year. And I think the market, or at least from a screening perspective, is worried how they're going to repay this debt. And I don't think there'll be any problem repaying the debt. They have enough cash on hand actually to repay both of them. But the company, we talked about this in the December conference call. They did a fireside chat, and they said, you know, stay tuned. We're going to explain how we're going to pay. They could just take on a bank credit line to repay it. I mean, but the key inflection point here, I think, is that they had all sorts of expenses that went up in 2022. They bought a company that didn't have any real revenue associated with it. They took in the cost structure of that new company, and they accelerated hiring on sales and marketing. All of those expenses will bear fruit in 2023, and I think you're going to see free cash flow start to form here. And if you exit next year with a 30% higher revenue number versus the streets at like 17 or 16%, and you start gushing free cash flow and you show you're a sustainable company, just to let you know what they do, I have absolutely no idea what they do. They're a software company. You can go on Value Investors Club and you can read a 2-year-old write-up on it. But what's really interesting about the write-up is that there is a huge market here, 65 billion going to 120 billion. And currently it's $1 billion business. So this company should do 20 to 35% compounding revenue growth for years to come, which is a really rare off of $1 billion base. And that to me is just incredibly attractive at this value. I mean, this kind of company was trading at 10 times, 15 times sales a couple of years ago. And now it's trading at 3 times, 3.5 times, something like that. So there's probably a lot of software stocks like this out there. This is the one I'm focused on because of the size of the market cap, the mistakes I made in the past, things like Zendesk, things like Splunk. These are too big of companies. They're very hard to swallow at premium valuations for private equity firms. AYX is not. And AYX could also be sold to a strategic, but it's the right size to get 100% premium from here. And I think the stock could be up 100% this time next year. barring, you know, whatever happens with the rest of the world. So with AYX, I own smallish common. I don't know if smallish for me. So it's like, I don't know, 7% common position or something. And I have size call spreads on. I own June 60 70s. I own October 60 70s. And I own Jan 24 is my biggest slug. And I own 70 85s in Jan 24. And for all these, I paid something along the lines of like $2 to make 10 or $2.65 to make 15 kind of thing. All, you know, 5x, 4x, 6x if I get paid on it. And, you know, I think there's a better than a coin flip chance of me getting paid on that. So these are the kinds of things I'm looking at right now. With QURE, I'm going to skip that one. So that's my goal. My catalyst in AYX is guidance. Oh, sorry. AYX also will benefit from foreign exchange. They had a big, or not big, smaller than NCR, but a headwind in the last 2 quarters on FX. And now for all of 2023, they should have a very big tailwind that I don't think is in any of the street numbers. So, you know, they're already doing low 30s ARR. That could be mid 30s now with the FX, you know, and the streets had like an 18% or 17% revenue growth next year. So I think it's all wrong, and we'll see what happens. But QURE, QURE. So I made this pretty big again. This is like a 9% common position. You know, they had their hemophilia drug approved since the last time I talked, I think. No, that happened before. And the stocks sold off with the rest of biotech because it didn't get acquired yesterday. It was pretty funny to see how all the biotechs were yesterday. They all went down. They didn't get acquired on the first day of JP Morgan. You know, QURE is not going to get acquired until after they read out their Huntington's data. And the Huntington's data is going to come in quarter 2. So the setup for QURE is this. Okay, it's very risky, but it's my belief that the stock won't go below 15, even if Huntington's is a complete wipeout, because you now have an approved hemophilia drug. They get double-digit royalties. You have something like $12 or $13 a share in cash. It might be even more than that. And you have 2 drugs entering the pipeline this year. So they're going to refresh the pipeline with 2 new gene therapy drugs. And that's kind of that'll be the setup if Huntington's fails in Q2. Okay. You also have a much easier chance for a sale of the company once Huntington's is over, because you can value it on the hemophilia cash flow and the early stage pipeline assets. Why is Huntington's so interesting? So my wife used to do a support group for Huntington's. Huntington's is a disaster of a disease. Basically, it's hereditary. And I believe if you have a parent that has it, you have a 50% chance of getting it, and you don't know you get it or have the gene for it. It doesn't come on until your 20s or 30s or 40s. And then once you get it, it's a very painful, a bad way to die, basically. I'm sure I'm getting some of that wrong, but it's just a terrible disease. And there's no cures for it. And they are doing this gene therapy, and it's been in the works now for years. And you're going to get some efficacy readouts in quarter 2. Now, the stock blew up December of 2021 when they released their biomarker data on the low dosage for the trial. So there's a low dose and a high dose. The market did not like the biomarker data for the low dose, and the stock went from like 30 to 20. Okay. But there's no efficacy data. And in the summer of last year, they announced that they were halting dosing in the high dose because of 3 significant adverse effects that happened right after the procedure. Okay. The Data Safety Monitoring Board looked at all the data, including biomarker data and imaging data. So they looked at efficacy, not efficacy functional data necessarily, but all the biomarker stuff. They have unblinded data, and they decided, based on the risk and benefit from what they saw, to redose the high dosing group. Okay, they did not have to green light that, but high dosing was reinstated in October of last year. What this tells me is that there is something there. Okay, there is at least something they're seeing. to say that the risk outweighs the cost for those three significant effects that occurred after the procedure. The most interesting thing about this trial is that this isn't like a typical biotech trial where it's a phase 3 or anything like that, where there's a large N and there's a very clear endpoint. This is a phase 1, phase 2 trial. This would form the basis for approval. But if they can show efficacy, not biomarkers, but efficacy, functional efficacy, unequivocally in this trial, it doesn't really matter what the extent of that efficacy is, as long as it's there. And if it's there, I'm not saying it is, the stock, could quadruple, over $100 a share. It would be $1 billion drug with no competition, and they would have a platform, a gene therapy platform. They have other drugs in the pipeline from Parkinson's and Alzheimer's, things like that. There's no read-through if this works to them. But these diseases are notoriously difficult to treat, right? These neurological disorders. Very, very difficult. So the way I look at it is you have like a $5 to $6 downside and, I don't know, $80 upside. And that the Data Safety Monitoring Board, greenlit redosing of the high dose. So it's very risky. And buying something for a trial readout is extremely risky, but that would make my year this year if that worked. So for that, it's 90% common. I don't really love any call spreads in that, given how much upside there is. You really can't find the right call spreads to put on. But I'm looking forward to seeing QURE and seeing what happens in quarter 2 there. What else is left to talk about here? AMPY, we're waiting to hear, obviously, about beta. We should get an update on that when they report earnings in February or March. Beta should be restarted in February or March. I think it's very likely that still happens. If it doesn't happen in February, March, it would happen, in April. But there's nothing that's kind of keeping me from thinking that won't happen. There's no reason to think it won't happen. Still on IAC, nothing's changed there. Still on BSM, nothing's changed there, except, BSM at $16 is hilarious. It's the same price as when oil was 50 and natural gas was 3. And now oil is 75 and natural gas is 5. Don't look at the front month of natural gas. You have to look at the curve. And, BSM is going to do record production this year. And it's the same price as it was when, the spread was much lower. So the curve was much lower. So it is what it is. I think I talked about everything, guys and gals. Any questions? I put out a small position in MSOS, the pot ETF. Very, very risky. Trades terribly. Never seen an industry trade more poorly than what that thing's traded like in the last 4 weeks after safe banking didn't pass. The pitch there is that at some point in 2023, there's even rumors of a safe banking deal, and the stock just doubles on the rumor of the passage. And I think you don't have much downside from here, at least in the next 6 to 9 months. On the flip side, I'm told the pop business is a disaster right now, and margins are bad, volumes are bad, and everybody hates pot stocks. So, caveat emptor with MSOS. Caveat emptor, something like that. Any questions? I'm going to log off. I'm pretty sure I covered everything I wanted to cover. All right. Nice seeing everybody. I'll be on if there's any reason to come on. Any good special sits that come out. I'm looking forward to doing a lot of special sits this year. I'm going to stay away from pre-merger ARB unless the financing markets get better. I do own, of course, NCR and AYX, but I'm not buying those based on any kind of, I don't consider that pre-merger ARB because there's no premium in there in either of them for deals, right? There's no Bloomberg articles or Wall Street Journal articles or anything like that. So to me, I have no problem owning things like that. There's no more DSP SHLX actually, Glenn. I looked, or I asked a friend about it, and the MLP game is pretty much over. And also, it's really hard to buy those ahead of the announcements because you're going to sit on it for maybe years before you get paid. And you have to just kind of wait for the majority minority announcement and then go from there. So I don't think there will be another one this year, but maybe we'll get lucky. All right. Let's hope the rest of 2023 is like the first 6 days of 2023, because it's been very good for me. Hope everyone has a great day, a great week, and I'll speak to you soon. Bye.